Hi everyone, Isaiah Riel here. Good morning or good afternoon. I want to share with you what I've been working on here recently. What I've done is I made a 5-part video and podcast series just for you. And this video and podcast series goes over how to make a portfolio. Whether you're a conservative investor all the way up to an aggressive investor and everywhere in between. So of course there's 5 different risk tolerances, and I made a video and podcast for each type of risk tolerance of what type of portfolio you can make for yourself. Going over the asset allocations, so what type of investments we can use to build this portfolio, as well as the percentages, so what percentage of each type of asset allocation do we use to build each type of portfolio. In addition, I share with you the outcomes. So Charles Schwab is the company that made these templates for these portfolios that I'm sharing with you. In addition, what they did was they ran historical tests of each type of investment allocation for each type of risk tolerance, and they've got an average historical return that they've got and concluded from doing these tests. I'm going to be sharing that with you to give you an idea of what type of returns that these different portfolios have seen. Of course, I have to do my due diligence and let you, the viewer or listener, know that of course past performance is no indication of future returns. And in addition, as investors, we know that there's risk involved. Investing involves some type of risk, and with that risk comes the possible loss of our principal. So of course, I have to do my due diligence, let you know that, the viewer or listener. But without further ado, let's go ahead and get started. I'm excited to share these 5-part video and podcast series with you. I hope you enjoy. If you have any questions, concerns, comments, thoughts, please feel free to leave them in the comments section or send me a message. I look forward to hearing from you. Without further ado, let's go ahead and get started. Thank you so much. Hi everyone and welcome. This is the Real Sense Podcast, where we bring you bite-sized advice to help you make real sense of money, the markets, and helping you create a legacy for you and your family. Wherever you may be, however you may be listening, thank you for making this a part of your day. In today's episode, I'm going to share with you how to create a conservative portfolio for yourself. I'm your host, Isaiah Riel, financial advisor with Laguna Wealth Advisors. Hi everyone, I hope you're having a great day. In this episode, I'm going to share with you how to create a conservative portfolio for yourself. I'm going to share with you the 4 key items that you need to build this portfolio. I'll share with you examples of what types of investments you can possibly use to create this portfolio, as well as the exact percentages of how much to put into each investment. And in addition, I'll share with you what types of people tend to invest in this type of portfolio, as well as the outcomes. And by investing in a conservative portfolio, what through historical data has tended to be the outcome having this portfolio. Without further ado, let's go ahead and get started. First, we'll start here. So who should be in a portfolio like this? What type of people tend to invest in a conservative portfolio? Of course, the easy answer is anyone can invest in a conservative portfolio. It depends on most likely your needs, your lifestyle, your risk tolerance, and really what suits you. Majority of the time, it's usually pre-retirees or retirees who tend to invest in a conservative portfolio. So typically, they have 2 main focuses when investing in a conservative portfolio. They're thinking of number 1, income. What can I do with my money to help produce some type of income generation for myself? Because most likely I need to help pay for my daily living expenses as well as maintain my lifestyle. So the first focus would be income. What can I do to provide more income? The second is stability. Of course, this probably goes for everyone, but especially for retirees and pre-retirees, their main focus too as well is what can I do to make sure my money lasts as humanly possible? Ideally, I would like my money to last my entire lifetime and perhaps leave a little bit of a legacy for my family. So a focus for them is what can they do to make sure that their money lasts and maintains throughout their life, and also to provide them some type of stability. Of course, though, anyone can invest in a conservative portfolio. If you tend to get a little queasy when it comes to thinking about investing, or you get worried that you don't want to lose the money that you've saved, then perhaps a conservative portfolio may be a suitable option for you. So let's transition to the next part here. What does a conservative allocation look like? How do we build one? So a conservative portfolio is going to be, again, for investors who are looking for current income. They're looking for income for themselves, as well as stability. They want to do their darnest to make sure their money lasts their lifetime as much as humanly possible. and they're less concerned about growth. Again, by being conservative, you're not willing to take as much risk because by helping to grow your portfolio, that requires taking on additional risk. These individuals are probably more focused on income generation as well as just maintaining what they have, so that's important to remember. Now, how do we build this portfolio? How do we create a conservative portfolio for ourselves if this is something of interest to us? I like to start with this. Let's pretend we're building a house. What do we do first when we're looking to build a house? We have to lay the footings. We have to lay a foundation for ourselves. Same thing happens when it comes to investing. We have to lay a foundation for ourselves when it comes to building our portfolio. So the foundation for ourselves is going to be this. It's going to be in the fixed income and cash investments. In fact, the thing about this portfolio, because it's conservative, a majority of this investment is going to be a foundation because we're not willing to take on a great amount of risk. The first part is this. We're going to put 50% of our money into fixed income investments. So what's fixed income? According to Investopedia.com, fixed income can be investments like corporate bonds and treasury bonds. So they're going to be bonds. And the reason why we invest a majority of the monies into bonds is because they tend to have periodic income received at regular intervals. So they provide you a steady stream of income. Typically, it's in the form of monthly or quarterly dividends or interest from the bonds, but they're going to provide you some type of income generation. That's why a large majority of retirees tend to invest quite a bit into bonds because they're more stable, obviously, but also too, they provide you some source of income for themselves to help them maintain their lifestyle. So half the money we have, 50% is going to be put into those fixed income bond type of investments. The other portion that's going to help us lay that groundwork for us, the foundation for our portfolio, is going to be cash investments. So we're going to put 30% of our overall money into cash investments. So Investopedia.com says examples are savings accounts from your bank, high yield savings accounts, CDs, money market funds, treasury bills. They're investments that most importantly help preserve your capital. So for example, if we put money into a savings account at our local bank, and let's say the stock market's falling in value, what's going to happen to that money in your savings account? Is it going to fall just like the stock market's doing? Odds are no, it's not. It's going to remain the same. It's going to remain steady because really no correlation to what's happening in the stock market. It's there as an emergency, but more importantly, it's there to help preserve your capital because again, in this type of portfolio, we're looking at something to help stabilize our money and to help us maintain what we have, hopefully for a long period of time. So the groundwork, the foundation for this portfolio is going to be 80%, and that 80% is going to be made up of the fixed income and cash investments. And by doing that, again, it's going to allow us to provide some stability for our portfolio. It's going to help us generate some income for us too as well, to help us with our lifestyle. And then also too, it's going to help us preserve our capital. So that's the groundwork. That's going to be the foundation for this portfolio. And the remaining 20% of our portfolio is going to be where we get a little bit creative with what we look to do with our investments. Of course, as investors, we're thinking long term, right? And so because of that, bonds are a great tool, cash investments are a great tool, but we need a little extra oomph, a little extra push too as well to help us achieve those long-term goals of maintaining our money and making sure it does its best to last our lifetime. So with that, we're going to look to invest 20% of our monies into equities, which are, for example, stock investments, stock funds. We're going to look to put 15% of our overall money into large cap equity investments. CNBC does a great job of giving us an example as to what type of companies fit in this large cap equity. So examples are Apple, Amazon, Johnson & Johnson, JP Morgan Chase. Those types of companies we've all heard of before, most likely. Those are the companies that are part of this large cap equity. They're companies that are stable, they know how to make profits, they know how to make revenue, and also too as well is that you're investing into companies with a market capitalization of more than $10 billion. So these companies have quite a bit of stock outstanding. There's quite a few investors who invest in these companies because they are stable. These companies are not going to give you astronomically high returns. Throughout historical data, they've shown that these companies provide you solid returns. So they provide some stability for you. And in addition to that, depending on what type of investment you look to invest into, they may provide you dividends too as well. And the last 5% of where we're going to put our money for this equity portion is going to be in international equity. So that's going to be investments overseas, abroad. They're not going to be here in America. And the reason we do that is for a few reasons. One is diversification. We've probably heard that word before. We are already diversifying this portfolio because we're putting 80% of our monies into fixed income and into cash investments. Those are two different types of investments. We're putting monies into large cap equity, and now we're putting some monies into international investments. So we're spreading our money around. We're diversifying. That's one benefit of going overseas. Another one too as well is it helps us lower our overall risk in the portfolio. Because like the old adage says, don't put all your eggs in one basket. When it comes to the money we're investing in equities, we're not going to put all of it just in large cap equity in the US markets. We're going to put some abroad. So that's why we're going to put 5% of our monies overseas, because it helps us lower our risk, it helps us diversify. And lastly, by investing internationally, it could be a smart move because there's potential for higher rates of growth abroad by investing a small portion into international. And Vanguard, one of the largest institutional money managers, had a great study. They found that through historical data, the average returns of the international developed markets and the US stock markets actually were very similar over the long term. By investing into the developed markets internationally, it'll provide us a little bit of stability and maybe perhaps, depending on what you look to invest into, some dividends too as well. So as a recap, to build this portfolio, there's 4 key points. The first part is laying the foundation. We're laying the foundation by putting 50% of our money into fixed income, into bond investments. They're going to provide stability and they're going to provide us income for our account. The other portion of the foundation is 30% into cash investments. By investing into cash investments, it's going to help us preserve our capital. And the last 20% of our portfolio is where we get a little bit creative. So we put 15% of our overall money into large cap equity. Those are the blue chip type of companies. Typically, like Investopedia.com says, these large cap equity investments tend to be a long-term core investment strategy for people because of their stability and because they provide dividends. And that last 5% is going to go internationally because we diversify our money, we're going to try to lower overall risk, and of course, we're going to try to get potential for higher rates of growth abroad. So that's how we create the portfolio. That's the framework for building a conservative portfolio for ourselves. Again, our main focuses are going to be income as well as stability, and we're going to be less concerned about growing the portfolio. Granted, we're going to put a little bit of money, it's 20%, to try to grow it, but again, our main focus is going to be seeking current income and having stability for our portfolio. And lastly, outcomes. So by investing in a conservative portfolio, what type of outcomes have we seen through history, historical data? Charles Schwab did a study for us. And they found that Charles Schwab Investment Advisory, with the data provided by Morningstar, they went back in time and went from 1970 to 2014 and found that with this type of allocation, with this exact percentages, with these types of 4 key components to building the portfolio, through compounded annual average returns and seeing what the minimum and maximum annual total returns were of these hypothetical asset allocation plans, what type of average returns did they find? So by investing in this type of portfolio, to give you a little bit of idea, a ballpark, a perspective, the average annual return was about 7.8%. In their best year, they came out with 22.8%, and in the worst year, they were down negative 4.6%. So that gives you a little bit of idea as to what type of average returns that they saw from that time frame. Again, it's from 1970 to 2014. So my friends, that's how we build a portfolio for ourselves, a conservative portfolio. With any questions, with any thoughts, please feel free to leave them in the comment section. I would love to help you or hear your feedback. I look forward to talking to you soon. If you haven't done so already, please like us on Facebook as well as Instagram. We provide some great content there too as well. Without further ado, enjoy the rest of your day, and we'll talk to you real soon. Take care.